Please like, share, and subscribe. Wishing you happiness and good luck every day.
You ever look at the stock market and just wonder, how does anyone actually figure this stuff out? Well, today, we're going to try and demystify one of the most essential skills in all of finance, valuing a company. I mean, it's the the trillion-dollar question, right? What is the true value of a company behind all the hype and the crazy headlines? It's a question every single investor has to grapple with, and getting it right, or even close to right, can make all the difference. So to guide us on this journey, we're going to lean on a real giant in the field, Professor Aswath Damodaran. His Little Book of Valuation is legendary for taking these huge, complex ideas and making them crystal clear. We're going to break down its most powerful ideas for you right here. So here's our game plan. First, we're going to talk about what value even is. It's more than just a number. Then we'll explore the two main paths analysts take to find it. And this is the cool part, uncover the bridge that connects them. After that, we'll see how this all changes as a company gets older, and we'll wrap up with some absolutely essential rules for the road. Okay, let's dive right in. Section 1, before we even think about a spreadsheet, we've got to ask a bigger question. What are we even talking about when we say value? You know, the whole point of this book, really, is that valuation shouldn't be some kind of mysterious black box that only Wall Street pros can open. You don't need some advanced degree to get the basics. It's a tool, a skill that lets you cut through all the market noise and make your own smart decisions. Okay, section 2. This is where we get into the real heart of the matter. Kind of like a great debate. See, there are basically two main paths you can walk down when you're trying to value something. Two totally different ways of thinking about this whole thing. And you've got to understand them both because everything else really builds on this. All right, so path number 1 is what we call intrinsic valuation. I want you to think of yourself as an architect here. You're not looking at what other buildings are selling for. No, you are carefully, meticulously building the value of this company from the ground up, using its own blueprints. You know, its cash flows, its potential for growth, and all the risks involved. You're trying to figure out what it should be worth, completely separate from all the chatter in the market. Now, path number 2 is called relative valuation. And honestly, it's less about valuation and more about pricing. So if the first one was an architect, this time you're a real estate agent. You're not trying to figure out the true value of a house based on its foundation and materials. Nope. You're just looking at what the house next door sold for and the one down the street. You're using the market as your guide, trusting that it gives you a pretty good ballpark. So you see the huge difference in philosophy here, right? Intrinsic value, that's for the person who believes the market makes mistakes. You're a bargain hunter, looking for something the crowd has totally missed. But relative value, that assumes the market is usually pretty smart. You're just trying to see if your company is priced fairly compared to its buddies. Okay, I know this chart looks a little intimidating, but trust me, the idea behind it is actually pretty straightforward. Let's just walk through it together. You start at the top with a company's market price. But to compare it to anything, you need to scale it. So you divide that price by something like earnings or revenue, and that gives you a multiple, like the famous PE ratio. Then, step 2, you look at the multiples for a bunch of similar companies. And here's the kicker. Step 3, you can't just stop there. You have to connect it back to the story. Why is your company's PE ratio different? Does it have better growth prospects? Is it riskier? The number is just the start of the conversation. So we've got these two big ideas, right? The architect versus the realtor, intrinsic versus relative. But here's the big aha moment from the book. Professor Damodaran says the best analysts, the really great ones, they don't just pick a side. They build a bridge right between them. A bridge that connects a great story with cold, hard numbers. And wow, this diagram, it just lays it all out perfectly. It shows you exactly how that bridge works. See, a truly great valuation isn't some soulless spreadsheet. It always starts with a narrative, a story you can tell about where this company is headed. And every single part of that story, as you can see, has to plug directly into the engine room of the valuation, those key drivers. So let's break down what those drivers actually are. It's really just 3 big questions. First up, revenue growth. The story here is just how big can this company get? What's the total market look like? And how big of a slice can they realistically grab? Second, profitability. This is your story about what makes the company special, what gives it pricing power to earn good margins. And third, investment efficiency. This is the reality check. How much money do they have to plow back into the business to make that growth story happen? Okay, this is where the rubber meets the road. Let's look at a real company to see how this works in practice. Take a company like Zomato, the huge food delivery service in India. The story is about the absolute explosion of the Indian middle class and the convenience of food delivery. That story, that feeds directly into your revenue growth number. Then, the story about Zomato being a market leader, having a strong brand, that tells you what kind of operating margins you can expect. See? Every piece of the story has a home in the numbers. All right, which brings us to a really important point in Section 4. This whole process, this story-to-numbers bridge, it isn't static. It actually changes, and it changes in a big way depending on how old a company is. So, if you're looking at a young, high-growth company, think about Zomato back when it was just starting, or maybe an early-stage Airbnb. Here, the story is everything. It's all about the future, the promise, the potential. You're telling a story about a massive, untapped market. Who cares about profits today? The whole valuation is riding on that big, bold narrative about future growth. Okay, but now let's pivot to a totally different kind of company, a mature, established giant like Unilever. The story here has nothing to do with explosive growth. That ship has sailed. Now, the narrative is all about efficiency. Can they improve their margins by a little bit? Are they being smart with their huge cash piles? Are they paying dividends, buying back stock? The story is less about revolution and more about smart, steady management. And then, of course, there's the final chapter, a company that's in decline. Think of a business like Sears during its last few years. Here, the story takes a grim turn. It's not about growth anymore. It's about survival. The big question becomes, what are the pieces worth? If we sold off all the real estate, all the inventory, what would be left? The story is a tough one, a calculation of liquidation value against the tiny chance they might pull off a miracle. Okay, so we've been on quite a journey, right? From stories to numbers, from startups to dinosaurs. For our final section, let's wrap it all up. Professor Damodaran gives us some fantastic, timeless rules for the road. Basically, some core principles to keep you grounded. And these are just so good. Simple, but incredibly powerful. First, remember that risk always affects value. Second, that growth isn't free, and sometimes it can actually destroy value if you pay too much for it. He also reminds us that all good things come to an end. No company grows to the sky forever. It's about looking at the past, sure, but really thinking about the future. And a big one, don't get stuck on a single number. An average is almost always better. And maybe most importantly, just accept that this is messy. There's going to be uncertainty. Your job is to deal with it, not pretend it doesn't exist. But if I had to leave you with just one single idea, one thought that pulls everything we've talked about together, it would be this. Because at the end of the day, a great valuation, it isn't just a beautiful story. And it isn't just a flawless spreadsheet. It's the magic that happens when you connect them. It's the art and the science of turning those stories into numbers. You know, we're constantly just bombarded with numbers, right? Stock prices, market caps, earnings reports. It's so easy to look at those numbers and think, okay, that's what it's worth. But here's the secret. Value, it's not just a number on a screen. It's more like a story, a whole landscape. And today, we're going to learn how to read that landscape. And we've got the perfect guide for this little journey. None other than the Little Book of Valuation by the legend himself, Aswath Damodaran. We're going to break down some of his key ideas to help you see the whole world of investing in a totally new way. Who would have thought Oscar Wilde would give us one of the best pieces of investing advice ever? He said, a cynic knows the price of everything, but the value of nothing. And man, in today's market, it is so easy to be that cynic. But to be a great investor, you have to learn to see beyond that price tag. So what's the big deal, really? Price, value, sounds kind of the same, doesn't it? Well, it's not. And the gap between those two little words, that's where fortunes are made and lost. So let's crack this thing open. This right here, this is the foundation of everything. Seriously, forget all the fancy charts and spreadsheets for just a second. The entire game of smart investing really boils down to one simple thing: understanding the gap between the price you pay and the value you get. If you can get this right, you are way ahead of the curve. And here it is, the golden rule. It sounds so simple, it's almost silly. Don't pay more for something that it's actually worth. But if you truly, deeply internalize this one idea, you basically become immune to all the hype, all the FOMO, all the speculative bubbles. because it forces you to stop and ask the most important question of all. What is this thing really worth? But if you ignore that golden rule, well, then you're not really investing anymore. You're just playing a very, very expensive game of musical chairs. You're buying something just because you hope you can sell it to somebody else, the greater fool, for more money down the line. But as the quote asks, where are you going to be when that music inevitably stops? You do not want to be the one left standing. Okay, so we get it. We need to figure out what an asset is worth. But how? Well, the good news is you don't need a PhD in finance. There are really only two main roads you can take to figure this out. Think of them as two different lenses for looking at the very same problem. And here are our two lenses. On one side, you've got intrinsic valuation. This is kind of like being a detective. You're looking for clues within the asset itself, its fundamentals, its ability to generate cash. On the other side, you've got relative valuation. This is more like being a real estate agent. You're just looking around the neighborhood to see what similar assets are selling for. Two totally different approaches. So let's zoom in on that intrinsic path first. With this approach, you're basically buying a business, a machine that's designed to make money. The more cash that machine can predictably pump out over its life, the more it's worth. It's as simple as that. It's all about the business itself, not the daily mood swings of the market. Now, for relative valuation, this house analogy is just perfect. When you buy a house, you don't calculate its future cash flows, right? No! You just look at what the house next door sold for. And that's why Damodaran cleverly calls this pricing, not valuing. You're not trying to find its true, deep worth. You're just figuring out its current market price. Right now, you might be thinking, okay, this is all great for stock market gurus, but what does it have to do with me? Well, the thing is, valuation is like a superpower, and it goes way beyond just Wall Street. It's a fundamental skill for pretty much anyone in business. I mean, just look at this lineup. Of course, you've got your stock pickers and your market timers, but venture capitalists, they use it to decide if the next big startup is worth funding. Corporate strategists use it for billion-dollar mergers. Even accountants need it. It's literally the language of business. And this timeline just drives that point home. Think about the life of a company. From the very beginning, when a startup needs cash from a VC, to the day it goes public with an IPO, all the way to its life as a huge, established company trying to make smart decisions. Valuation is right there at every single step of the way. Okay, so we've got the theory down. Now it's time to get real. Because valuation, it's not some clean, perfect process you do in a lab. It's messy, it's human. And there are three, let's call them uncomfortable truths that you just have to accept before you even begin. All right, let's just rip the Band-Aid off right away. There is no such thing as a purely objective valuation. It doesn't exist. Every single one, without exception, is biased. Why? Because we're human. We have hopes, we have fears, we have opinions we formed before we even looked at the numbers. We can't help it. So where does all this bias come from? Well, sometimes it's simple. Maybe you just love a company's product. Other times it's more complicated, like institutional pressure on analysts. So what do? The key is self-awareness. Be honest with yourself about your biases, and then chain yourself to the data. Let the financial statements tell the story, not the pundits. Now this next one, this can be a tough pill to swallow, especially if you're a perfectionist. Even if you do everything by the book, your final valuation number is going to be wrong. Yeah, the goal isn't to hit the bullseye with pinpoint precision. The goal is just to be in the right ballpark. So why are we always wrong? Well, it boils down to three main things. First, we just make mistakes converting info into forecasts. We're human. Second, the company itself is unpredictable. Its path can change in a heartbeat. And third, the entire world can shift under our feet. Think recessions, interest rate hikes, global pandemics. You just can't predict that stuff. And these examples say it all, don't they? Back in 2001, everyone thought Cisco would grow to the moon. They were wrong. And in 2019, literally no one's valuation model for Marriott included a global pandemic that would shut down travel. The big lesson here is that uncertainty isn't some flaw in your model, it's a basic feature of the future. And that brings us to our final uncomfortable truth. And it's a big one because it's so counterintuitive. In this world of big data and supercomputers, we're tempted to build these incredibly complex, detailed models. But more often than not, simpler is actually better. Just follow the logic here for a second. More detail means you need more inputs, right? Well, Every single one of those inputs is another chance for you to be wrong. Pretty soon, your model becomes this giant, complicated black box, and you don't even know what's driving the final number. So the rule is simple. Less is more. Use the simplest model that gets the job done. Okay, so valuations are biased. They're always going to be wrong, and simpler is better. You might be feeling a little discouraged, like why even bother? But don't be. This is actually the good part. We just need to completely reframe what the goal is. And this, right here, might be the single most important lesson of all. Success in investing doesn't come from being right. It comes from being less wrong than everyone else. That's it. That is the entire game. Your edge isn't about predicting the future perfectly. It's about having a better handle on the present and being a little less off base about the future than the rest of the market. So yeah, the future is always going to be a mystery. Every valuation we do will have its flaws. The real question is, are you ready to accept that? Are you ready to get in the game and start the journey of just trying to be a little less wrong? Because that right there, that's where successful investing actually begins. All right, welcome to our workshop. Today, we're grabbing our hard hats because we're not just going to talk about finance. We're going to build a powerful valuation toolbox from the ground up. And we're using the blueprints from one of the absolute masters of the craft, Aswath Damodaran. So let's get to it. You know, every investor runs into this exact problem. On one side, you've got a powerhouse like NVIDIA. We're talking explosive growth. But its future, well, it's a thrilling but pretty unpredictable ride, right? And on the other side, you have a company like Altria, super stable, predictable, pays you a nice, steady dividend, but its growth, pretty limited. So it's the ultimate showdown, potential versus predictability. How in the world do you even begin to compare these two rationally? Well, to make that kind of choice, a gut feeling just isn't going to cut it. Nope. You need a set of power tools. Tools that can slice right through the hype and the noise and the uncertainty to show you what a company is really worth underneath it all. And that's exactly what we're here to do. We're going to build your valuation toolbox one essential piece at a time. So here's our game plan for today. First, we're going to lay the foundation, the cornerstone of all of finance, the idea that time is money. Then we'll bolt on a risk gauge to our kit. After that, we'll learn how to read a company's own story, its financial statements. And finally, we'll sharpen our statistical tools so we can turn all that raw data into actual useful insights. Let's start building. Okay, let's grab our very first tool. And listen, this one is the absolute foundation for everything else we're going to talk about today. It's a simple idea, but it is a complete game changer. Money has a time dimension. See, $1 in your pocket today and the promise of $1 10 years from now, they are not the same thing. Once you truly get this, you've mastered the first and maybe the most important rule of valuation. So why is that? Why is $1 in your hand right now so much more valuable than $1 you've been promised for next year? Well, it boils down to three really basic things. First, it's just human nature, right? We'd rather have stuff now than wait for it. Second, there's inflation. That dollar is simply going to buy you less stuff next year than it does today. And third, and this is the big one, there's always risk. A promise of cash in the future is just that, a promise. It's not a guarantee. So the technique we use to adjust for all of that, our impatience, inflation, and risk, is called discounting. And the tool for the job is called present value. It's this brilliant little mechanism that lets us take any amount of money from any point in the future and figure out exactly what it's worth to us in our hands today. The secret ingredient here is something called the discount rate. It's a single percentage that bundles all that future uncertainty into one neat number. And this slide right here shows you just how powerful this is. Now, I know the formula on the left might look a little intimidating, but trust me, the concept is simple. All you're doing is taking that future cash and shrinking it based on that discount rate and how long you have to wait. Now, look at the example on the right. A promise to get $1,000 in 10 years, assuming an 8% discount rate for risk and inflation, it's only worth about $463 to you today. Yeah, less than half. That is the incredible power of time at work. Okay, but let's be real. Life isn't usually a single payment way out into the future. What about a steady stream of this same payment over time? Well, that has a name. It's called an annuity, and I guarantee you've run into this before. If you've ever had a car loan, a mortgage, or student debt, that's an annuity. It's just a predictable series of payments for a fixed amount of time. And this is where this tool helps you make actual real-world decisions. Check out this car buying scenario. You can pay $10 grand in cash today, or you can make 5 annual payments of $3,000. Which one's the better deal? Well, the formula does the work.
Using a 12% discount rate, the present value of that payment plan is actually over $10,800. The insight is crystal clear. That payment plan is more expensive. Taking the cash deal saves you real money.
Now, let's take this idea and push it to its absolute extreme. What if the payments just never stopped? A stream of cash that goes on forever is called a perpetuity. Now, these are super rare in the real world. The classic example is a weird type of British government bond from centuries ago, but the concept itself is an incredibly powerful shortcut for valuing things, as we're about to see. And this is where that abstract idea becomes so incredibly useful. We can tweak the perpetuity model just a little bit to value a stable company. We just assume its dividends will grow at a slow, steady rate, forever. Look at the math here. A stock paying a $2 dividend that's expected to grow at 2% a year, with you, the investor, wanting an 8% return, well, that stock is worth exactly $34. All that future complexity gets boiled down into one simple, beautiful equation. It's a cornerstone of valuing stocks. So we've been using terms like discount rate and required return, but you're probably asking, where do those numbers even come from? Well, the answer is risk. You simply cannot value anything correctly until you can measure its risk and put a price on it. So for our second tool, we're going to learn how to do exactly that.
Okay, so when you invest in a single company, say Disney, you're actually facing two different kinds of risk. First, there's company-specific risk. Maybe their next big Marvel movie is a total flop or a new theme park doesn't do so well. But if you own a bunch of different stocks, these kinds of risks tend to cancel each other out. But then there's the other kind, market risk. Things like a recession or rising interest rates. That stuff affects almost every company, and you can't get rid of it by diversifying. That's the risk that investors demand to be compensated for.
So how do we measure this market risk that we just can't escape? Well, the most common tool for this job is called beta. Honestly, just think of beta as a simple risk score that tells you how sensitive a stock is to the overall market's movements. The market itself has a beta of exactly 1. So if a stock's beta is over 1, it's more volatile, riskier than the market. If it's less than 1, it's more stable. It's just a simple, standardized gauge for risk. Look, it's true that some of these academic models have their issues, but the core message here from Damodaran is absolutely non-negotiable. You can argue all day long about the best way to measure risk, but you cannot, under any circumstances, just ignore it. Every single investment decision you make is also a decision about risk, and that risk has to be priced into your valuation. End of story. Okay, awesome. We have our tools for time and for risk. But what about the raw materials? Where do we get the numbers to even plug into our formulas? For that, we need our third tool, accounting. And the trick here is to stop thinking about financial statements as some boring chore and start seeing them as the language a company uses to tell you its own story. First up, we have the balance sheet. The best way to think about this is like a financial photograph of the company on one specific day. On one side, you've got all its assets, everything the company owns, like cash, factories, inventory. And on the other side, you have liabilities and equity, which basically shows who has a claim on all those assets. And the one iron law of accounting is that these two sides must always be in balance. Assets have to equal liabilities plus equity, always. So if the balance sheet is a photo, then the income statement is like a video. It tells the story of how the company performed over a stretch of time, like a quarter or a whole year. And it's a journey. You start at the very top with total sales, what we call revenues. Then you just start subtracting everything, all the costs of making the product, running the business, paying interest on debt, paying taxes, until you work your way all the way down to that famous bottom line, net profit. Now, this next part is one of the most important lessons in all of finance. Profit is not the same as cash. A company can look super profitable on paper, but have no money in the bank. The statement of cash flows is our reality check. It totally ignores all the weird accounting rules and just follows the actual money. It shows you exactly where the cold, hard cash came from. Was it from its main business, from selling off assets, or from borrowing, and where it all went? So we have our core concepts. We know how to read the statements to get the raw numbers. But the challenge today isn't a lack of information, right? It's that we're drowning in it. It's information overload. So our final set of tools is all about cutting through that noise to find the real signal. It's time to add some statistical muscle to our toolbox. This is such a perfect example of why just using the average of something can get you into trouble. See, with that symmetric, bell-shaped data, the average is fine. But look what happens with skewed data. Think about house prices in a city that has a few mega mansions. Those crazy expensive houses will pull the average way, way up and give you a totally distorted picture of the housing market. In cases like this, the median, the number that's literally in the middle of all the data points, gives you a much more honest view of what's actually typical. And finally, what if we want to figure out how two different things are related? Let's say, how does inflation affect interest rates? That's where our last tool, regression, comes in. This scatter plot shows the idea perfectly. Each of those dots is just a data point. And all regression does is use statistics to draw the single best fit straight line through that cloud of dots. The slope of that line then gives us this really powerful estimate. It tells us, on average, how much interest rates tend to move when inflation changes by 1%. And just like that, our toolbox is full. We have the concept of time value to compare money across the years. We have models to measure and put a price on risk. We have accounting to translate a company's story into numbers. And we have statistics to find the real insights hiding in all that data. You are now officially equipped with the essential power tools of valuation. So, the only question left is the one you see right here. With this new toolbox in hand, what's the first thing you'd want to analyze? A high-flying tech stock, a small business down the street, maybe a piece of real estate? And maybe even more important, now that you have the tools, what is the very first question you would ask to kick off your valuation?
Welcome to The Explainer. Today, we're putting on our detective hats. Our mission? To look right past the flashing stock price on the screen and uncover what a company is really worth, its true underlying intrinsic value.
So, to make this real, let's start with a simple question about a company most of us have in our pantries. Back in mid-2023, a single share of Kraft Heinz was trading for about $36. But here's the real question. Was it actually worth $36? And how would you even begin to figure that out?
Well, to find the answer, there are basically two different trails you can follow. The path on the left means you figure out the value of the entire business, all of it, the whole shebang, and then you subtract its debts to see what's left for the shareholders. The path on the right tries to calculate the value of that shareholder piece directly. Look, both paths should get you to a similar place, but for our investigation today, we're taking that first path, valuing the whole firm.
Okay, here's our game plan. First, we'll define what we're even looking for. Then, we'll dig up 3 crucial clues: cash, risk, and growth. After that, we'll put all those pieces together to solve the valuation puzzle. And finally, we'll see how our answer stacks up against the market price. Let's get into it.
All right, so before we even start gathering clues, we need to be crystal clear on what intrinsic value actually is. It's not some magic number that falls from the sky. Nope, it's a calculated estimate, and it's built by combining 4 key inputs that, together, tell the fundamental story of a business. So these are the 4 pillars of our case. First, how much cash is the company actually generating right now? Second, how fast do we expect that cash generation to grow? Third, how risky are all those future cash flows? And finally, since we can't predict the future forever, what do we think the business will be worth way down the road? Our first and honestly most important clue is cash flow. And this is absolutely crucial. For a minute, I want you to forget everything you know about accounting profits. We are following the real money, the actual cash that is the lifeblood of any business. It's what pays the bills, funds growth, and it's ultimately what can be returned to investors. Now, one way to measure this is something called free cash flow to equity, or FCFE for short. And you know what? The name pretty much says it all. After the company has paid for everything, its operations, reinvesting in new factories, and making its debt payments, FCFE is the cash that is left over. It's that pot of money that could, theoretically, be paid out directly to shareholders. So what's really important to see here is how we get to that number. It's not as simple as just looking at the company's profit. You start with net income, sure, but then you have to make a bunch of adjustments to turn that accounting number into real hard cash. You add back expenses that aren't actually cash, like depreciation. Then you subtract the real cash you spent on investments, and finally, you account for any changes in debt. And whoa, take a look at this. This really brings it home for Kraft Heinz. Check out the FCFE line at the bottom. Even though the company reported a positive net income every single year, the actual cash available to shareholders was negative in 2021 and 2022. Why? Well, because of things like big debt repayments. This just goes to show you how jumpy FCFE can be, and why it might not be the best clue for our case. So, to get a more stable, clearer picture of the cash the core business is churning out, we're going to use a different clue: free cash flow to the firm, or FCFF. The key difference is simple, but it's super powerful. This is the cash generated before any debt payments are made. Think of it as the total cash pie the business creates, which is then available to be split between both the lenders and the shareholders.
Now check this out. When we look at Kraft Heinz's FCFF, we see a totally different story, one that's much more consistent and positive. Yeah, that huge number in 2021 got a boost from some one-time asset sales, but the big picture is clear. The core business is a reliable cash machine. This is the stable number we need. Okay, now that we have our cash flow, our next clue is all about figuring out what that future cash is actually worth today.
Right, so not all cash flows are created equal. A dollar that's guaranteed to be in your pocket next year is worth more than a dollar you're just hoping to get. It's just common sense. The riskier a future cash flow is, the less it's worth to us today. And we need a way to measure that risk.
For shareholders, this risk is all wrapped up in a metric called the cost of equity, and it's basically built from 3 ingredients. First, the risk-free rate. Think of it as the return you could get on a super safe investment like a government bond. Second, the equity risk premium. That's the extra juice investors demand just for taking on the risk of the stock market. And third, something called beta, which just measures how much a specific stock tends to zig and zag compared to the overall market. A beta under 1, like Kraft Heinz has here, means it's typically a little less wild than the market as a whole.
So you plug in the numbers for Kraft Heinz at the time, and you get a cost of equity of 9.0%. The easiest way to think about this is that it's the minimum annual return that investors in Kraft Heinz expect to earn. It's their compensation for taking on the risk of owning the stock.
But hang on. Remember, we're valuing the entire firm, which is paid for by both shareholders with their equity and lenders with their debt. So we need a blended rate. We take that 9% for equity and we mix it with the company's lower after-tax cost of borrowing money. The result is what we call a weighted average cost of capital, which for Kraft Heinz works out to 7.56%. This is it. This is the official discount rate for our investigation, the magic number we'll use to turn future dollars into today's dollars.
Our third and final clue means we have to pull out our crystal ball a little bit. The company's value isn't just about the cash it makes today. It's about how much that cash is going to grow in the future. This is the part of the investigation where you have to make some smart, educated guesses. And here's a really critical point. Sustainable growth doesn't just happen by magic. As you can see here, it's a direct result of 2 things: how much a company plows back into its own business and how good it is at earning a return on that new investment. A company that reinvests a ton of money but gets lousy returns isn't actually creating value at all.
Now, obviously, we can't sit here and forecast cash flows year by year forever, right? That'd be crazy. So we need a shortcut. At the end of our forecast period, let's say it's 10 years, we use this formula here to calculate a terminal value. It's basically an estimate of what the company is worth from year 11 all the way into the future once it settles into a mature business growing at a slow, steady pace.
All right, this is it. The moment of truth. Our investigation is reaching its climax. We have all our clues: our forecast for Kraft Heinz's future cash flows, our risk-adjusted discount rate of 7.56%, and our assumptions about long-term growth. It is time to put this puzzle together.
Here's how it all works. We take every single one of those future cash flows we forecasted, plus that giant terminal value at the end of year 10, and we discount them all back today using our 7.56% rate. Discounting is just a fancy way of saying a dollar in the future is worth less than a dollar today. We add up all those discounted values and we get our answer. The operating business of Kraft Heinz is worth about $44.5 billion. But we're not done yet. We're not looking for the value of the business. We're looking for the value of a single share. So we have a few final adjustments. You take that $44.5 billion, you add the cash the company already has on hand, and then, and this is super important, you subtract out all of its debt. What's left over is the total value that belongs to the shareholders. From there, you just divide by the number of shares.
And so, after all that calculation, the result of our investigation, the intrinsic value we found for a single share of Kraft Heinz is $20.60.
And this leads us to the final and most fascinating twist in the case. Remember where we started? The market was selling shares for $36. Our investigation concludes the value is only around $20.60. Whoa, that is a massive gap. So what on earth does that mean?
Well, this final piece of evidence helps us make sense of that gap. This is what's called a sensitivity analysis. It basically asks, okay, what would have to be true about the future for our valuation to get all the way up to the market's price of $36?
And as you can see, to get there, Kraft Heinz would need to achieve, for example, 4% revenue growth and a 20% operating margin, both of which are way more optimistic than the assumptions we used.
And that leaves us with the fundamental question, the one that every single investor has to wrestle with. A valuation is just a story told with numbers. So, is our story, the one with more conservative numbers, closer to the truth? Or is the market's more optimistic story the right one? The messy, uncertain, and fascinating quest to answer that question, well, that is the very heart of investing.
Welcome to The Explainer. Today we're going to tackle a question that's right at the heart of investing. What does it actually mean for a stock to be cheap or expensive? It sounds pretty simple, but the answer is all about perspective. So we're going to dive into the world of relative valuation and figure out how the pros compare companies to hunt for those potential bargains.
All right, let's just jump right in with a puzzle that investors literally face every single day. You look at these three tech giants, you see their price-to-earnings ratios, and your gut instinct probably is to say, well, Microsoft, it's the cheapest at 11 times earnings. But is it really the best deal? Well, the answer is way more complicated than just picking the lowest number.
So to figure that out, we're going to break this whole thing down. We'll start with a basic idea of pricing, then get into the tools analysts use called multiples. We'll cover the 4 keys to using them the right way, understand what's really driving them, see it all work in a case study, and then we'll wrap up with a big picture question about your own investment philosophy.
Okay, first things first. Let's start with the absolute foundation of all this. The entire idea of comparing stocks comes down to one concept: relative valuation. And that's really just a fancy term for the art of comparison.
The core idea here is so intuitive. I mean, think about it. You would never buy a house without checking the prices of other homes on the block, right? Of course not. You don't value something in a total vacuum. You value it relative to its peers. And that same exact logic applies to stocks.
So the whole process, whether you're looking at a house or a global corporation, really boils down to these 3 essential steps. First, you find a group of similar companies. Second, you have to standardize their prices so you can actually make a fair apples-to-apples comparison. That's your price per square foot. And third, and this is critical, you have to adjust for all the unique differences because no 2 companies are ever exactly alike.
All right, let's see how this all gets built into the specific tools that analysts are using every single day. These standardized prices we're talking about, in the finance world, they're known as valuation multiples.
In this chart here lays out the entire process. At the top, you've got what you're paying for the asset, its market value. Then in the middle, you have what you're actually getting in return, things like revenues, earnings, or cash flow. The multiple is just the top number divided by the bottom. It might look a little complicated, but it's really just a series of choices you make to be sure you're comparing the right things.
So here's the thing you have to remember. Multiples are super simple to calculate, which also makes them incredibly easy to misuse. To avoid falling into some really common traps, we need to run through 4 key checks: the definitional, the descriptive, the analytical, and the application tests.
First up, the definitional test. This is the most basic check, but you would be shocked how often people get this wrong. You have to be absolutely positive that the numerator, the top part of your fraction, and the denominator, the bottom part, are consistent with each other.
Now this slide basically lays out the simple rules that stop you from making huge mistakes. If your numerator is an equity value, like the stock price, then your denominator has to be an equity value too, like earnings per share. You can't mix and match. You can't say compare the stock price to a firm-wide cash flow measure like EBITDA. That's earnings before interest, taxes, depreciation, and amortization. That is a classic mistake.
Okay, next up is the descriptive test. Once you know your multiple is defined correctly, you can't just take the average of all the companies and call it a day. You've got to understand the whole landscape of the numbers you're looking at because just a few extreme outliers can completely throw off the entire picture.
Just look at this data for U.S. stocks from January 2023. This is a perfect example. The mean, the mathematical average, P/E ratio was over 109. But the median, that's the value smack in the middle of the pack, was just under 14. That is a gigantic difference, and it's telling us that the average is being yanked way up by a few extreme values. And this bar chart shows us exactly why that's happening. See how the vast majority of companies are all clustered over on the left side with lower P/E ratios? But then you see that long tail stretching way out to the right? Those are the outliers. Those are the companies with sky-high PEs that are dragging the average up. And this is exactly why focusing on the median gives you a much more reliable benchmark for what's actually normal.
So, if we can't just trust a simple average, what really determines whether a company actually deserves to have a high multiple or a low one? Well, that brings us to our third check, the analytical test, where we really get to look under the hood.
It's not magic. It really isn't. Every single valuation multiple, it doesn't matter which one you're looking at, is driven by the same three fundamental things. How fast is the company expected to grow? How risky are its future cash flows? And how good is it at actually generating cash? That's it. That's the whole game.
We can actually see this relationship in the math. This formula, which comes from a basic valuation model, shows that the PE ratio is directly tied to the company's payout ratio, its growth rate, and its risk. Risk here is represented by the cost of equity, which is just the return investors demand for taking on the risk of owning that stock. So a company with higher growth and lower risk will, all else being equal, justifiably trade at a higher PE.
And this principle holds true for all kinds of multiples. You can see it really clearly in this table, which summarizes the key drivers. Notice the pattern? Higher expected growth or better profitability, like a higher operating margin, that always pushes the multiple up. But higher risk, that always pushes it down.
Okay, theory's great, but let's put it all together with our fourth and final key, the application test. We're going to see how all this works with a real-world example from the beverage industry.
So here we've got some data from back in 2009. If you just look at the trailing PE ratio, both Todhunter and Hansen look super cheap compared to the sector median of over 22. I mean, their PEs are both under 10. But then, you look at their expected growth rates. Todhunter is just chugging along at 3%, while Hansen is expected to grow at a blistering 17%. That's a huge difference.
To properly account for that massive gap in growth, analysts use this really clever tool called the PEG ratio. What it does is it helps level the playing field by looking at the price you're paying for each unit of growth. It's just the PE ratio divided by the growth rate. So for Todhunter, we take its PE of 8.94, we divide it by its 3% growth rate, and that gives us a PEG ratio of about 2.98.
Now let's do the same thing for Hansen. Its PE of 9.7 divided by its 17% growth rate gives a PEG ratio of just 0.57. And here's the aha moment. The sector's average PEG was 1.80. So compared to that, our whole perspective just flips. Hansen still looks like a potential bargain. But Todhunter, which looked cheap at first glance, now actually looks expensive once you factor in its really low growth.
And this whole exercise really leads us to a final, much bigger question, because the way you approach valuation really depends on your core philosophy about how markets even work in the first place.
I mean, look at the two sides of this. Are you an investor at heart? Do you believe, like it says on the left, that every company has some true intrinsic value and that the market's just going to eventually figure it out? If so, you'd probably favor a really deep dive analysis. Or are you more of a trader? Do you agree with the right side, that this whole intrinsic value thing is an illusion, and the only thing that really matters is how things are priced relative to each other right now? Your answer to that question really shapes which valuation tools you're going to find the most useful.
So, what's the takeaway? While comparing stocks using multiples seems simple on the surface, it's a tool that requires real care and a lot of nuance. You have to be consistent, you have to understand the distribution of the data, know what's driving the numbers, and then adjust for the key differences. It's a great reminder that finding value in the market is this complex dance between hard numbers and human judgment. And it leaves us with the ultimate question: are you looking for the right price? Are you looking for the right value?
So let's talk about valuing a company. When you hear that word valuation, what's the first thing that pops into your head? Is it, a giant, intimidating spreadsheet just jam-packed with numbers? Or is it more of a story, a really compelling narrative about a company that's going to change the world? Well, that's kind of the central conflict we see all the time. Is valuation an art, or is it a science? In this explainer, we're going to get right into that. And I think you'll see, the truth is, it's got to be both.
You really have two different camps. Over on one side, you've got the number crunchers. These are the folks who believe that value is all in the data. And you get the appeal, right? Numbers feel precise, they feel objective. But here's the trap. Without a story to ground them, those numbers can be twisted to say pretty much anything you want. Then, on the other side, you have the storytellers. They're all about the big vision, the market, that special something the company has.
And stories, well, they stick with you. They're powerful. But the big danger there is that a great story, without any numbers to keep it honest, can easily spin off into a complete fairy tale. So here's the big idea, the key takeaway. A really good valuation isn't about picking a side here. It's about building a bridge. It's a process that connects a powerful, coherent story about a business directly to the solid numbers in a model. You see, every number has to have a story behind it, and every story has to be backed up by a number. And today, we're going to learn exactly how to build that bridge. Here's our game plan. We're going to break this down into 4 simple steps. First, we'll talk about how you actually craft a solid business story. Second, we'll run that story through a little reality check I like to call the 3P test. Third, and this is the fun part, we'll connect that story to the actual numbers. And last, we'll see why evaluation is never really a finished product. It's more like an ongoing conversation. All right, let's jump in with step 1, crafting the business story. Look, before you even dream of opening up a spreadsheet, you have to build that qualitative foundation. You need a narrative, a story that makes sense of where the company's been, where it is right now, and most importantly, where you think it's headed. And this isn't just about being a creative writer. This is about rolling up your sleeves and doing your homework. You got to dig into at least 5 key areas. You need to know what business the company is really in. You have to comb through its financial past. You got to understand the entire market it's playing in, size up the competition, and finally, take a step back and see how the big picture, the macro economy, might affect everything. Now, to make all this feel a bit more real, let's use a case study. We're going to look at Zomato, the Indian food delivery company, right around the time of its big IPO in 2021. I mean, this is the perfect kind of company for this exercise. Young, tons of potential, a place where the story is just about everything. Think about it. They had pretty small revenues, they were losing a ton of money, but they had a massive and growing slice of the market. How on earth do you put a value on that? Well, you start by telling a story. Okay, so let's try to build a story for Zomato. It could go something like this. You start with a big idea. The Indian food delivery market is just going to explode over the next 10 years. Then you say, okay, in that massive market, Zomato is going to be one of the big winners, eventually capturing, say, 40% of it. You'd also assume their take rate stabilizes, and that as the business gets bigger, its profit margins get way better, maybe up to 30%. The story also has to be realistic, so we'd say they'll have to reinvest a ton of money at first, but that'll ease up. And finally, you got to acknowledge the risks. Let's say we attach a 10% chance that the whole thing just doesn't work out. So there you have it. That's our narrative. Now, once you have your story all laid out, you can't just run off to the races with it. Nope, you have to stop and really kick the tires on it. And that brings us to step 2, the 3P test. This is an absolutely critical reality check to make sure your story is actually grounded before you go and attach any numbers to it. So the test has 3 levels, and each one gets a little tougher. First up, is your story even possible? This is a really low bar. It basically just means there's some path, no matter how unlikely, for it to actually happen. Next, you ask, is it plausible? Now, this is a harder question. It means you can make a solid, reasoned argument for it. Maybe you've got some early data that backs you up. And then, the highest bar of all, is it probable? This means you've got some strong evidence that your story can not only happen, but it can scale up and really succeed. So if we apply this to our Zomato story, well, because it's tightly focused on restaurant delivery, a business where Zomato already had a proven track record of growing, we can pretty confidently say it's plausible and maybe even probable. Now, if we had told a much bigger story, like Zomato was going to take over all of Indian retail, well, that would have been a much, much tougher story to get past the test. The focus of our story is what makes it strong. Okay, so our story is crafted, and it's past our reality check. Now for the main event. Let's move on to step 3, which is really the heart of this whole thing, connecting story to value. This is where we take our narrative, our words, and we meticulously translate them into the numbers. This, my friends, is where we build the bridge. And what's so cool is that any company's value, no matter how complicated it seems, really just boils down to a few key drivers. You've got your cash flow drivers up top, things like revenue growth and profit margins. And then you have your risk drivers down below, like the cost of capital. Every single part of the story you've built has to connect to one of these boxes. There are no exceptions. Let's break that down. Think of it like this. Your story's big potential, right? The huge market it can capture, that all gets poured into your revenue growth number. The story about its competitive advantages, its moat, that shows up directly in your operating margins. And the story of how well the company can grow without burning tons of cash, that's all measured by its reinvestment rate. And of course, we have to deal with uncertainty. I mean, no story is a sure thing. We do this in two ways. First, there's the normal, everyday business risk, and we capture that in something called the cost of capital. But for a young company like Zomato that's losing money, there's a much scarier, existential risk, the chance it might not make it at all. So we capture that separately with a probability of failure. And here is where it all clicks into place for Zomato. Check this out. Every piece of that narrative we built earlier plugs right into one of these valuation drivers. The story about the huge Indian market? That becomes our revenue growth. The story about Zomato being a winner? That determines its operating margins. The bit about needing to invest in tech? That's our reinvestment number. And the riskiness of it all? That sets our cost of capital and our failure risk. You see? Every part of the story has its place. So once we have those inputs, the spreadsheet finally gets to do its thing. We apply our assumptions about growth and margins, and we start to see the future take shape. You can see it here with the operating profit. It starts with a big loss, but as our story about scaling up and maturing plays out, it's projected to become incredibly profitable a decade down the line.
But, and this is a really important point, profit isn't the same thing as cash. You have to account for taxes and, this is the big one, all the money you have to plow back into the business to get that growth. When we do that, we get what's called free cash flow. And just look at how negative it is in the early years. That perfectly reflects our story about heavy investment before it finally flips and starts generating a ton of cash. Then we take all those future cash flows, we discount them back to what they're worth today using our risk numbers, we make a few other adjustments, and after all of that, the whole process ends up spitting out a single number. Based on our specific story, the value we get for a share of Zomato is 43.16 rupees. But hang on a second. Is 43.16 the value? No, absolutely not. It's the value for our specific story. And this table just makes that point so clearly. If you tell a super optimistic delivery juggernaut story, the value shoots up to 150 rupees. If you tell a much more pessimistic story about slow growth, the value craters to less than 17. This proves it. Value is never some single objective fact. It's the logical conclusion of whatever story you choose to tell. And that leads us perfectly into our final and maybe the most important step of all. A valuation isn't some static document that you do once and then you're done. Step 4 is all about remembering that valuation is a conversation. You have to keep that feedback loop wide open. Look, the world is constantly changing, so your story has to be a living, breathing thing. As new information comes in, you have to ask yourself how it affects your narrative. Does it cause a story break where something happens that just completely undermines your whole model? Does it cause a story change where the company makes a big move and you have to totally reassess the core story? Or is it just a story shift where the main plot is the same, but you need to tweak some of the details? You have to be ready to let your story evolve. In the end, it really all comes back to this one idea. A credible, useful valuation requires you to use both sides of your brain. You have to be both the creative storyteller and the disciplined number cruncher. They're not fighting each other. They are two sides of the very same coin. So the next time you're looking at a company's stock price, don't just ask if the numbers add up. Ask yourself, what story is this price telling me? And do I actually believe it?
All right, let's dive into one of the biggest, most fascinating puzzles in the world of finance. How on earth can a brand new company, one that's not even making a profit, be worth billions of dollars? It's a world filled with unbelievable promise, but also just massive risk. And today, we're going to give you the roadmap to figure it all out.
And look, this isn't just some academic question. I mean, think back to 2012. Facebook goes out and buys Instagram for $1 billion. $1 billion. At the time, Instagram was only 2 years old, had basically zero revenue, and was actively losing money. On paper, it sounds completely insane. But there is a logic to it, a framework for putting a price tag on pure potential. And that's exactly the puzzle we're going to solve together.
So here's how we're going to break it all down. We'll start with why this is such a puzzle in the first place. Then we'll look at the two main ways you can even approach valuation. After that, we're going to get our hands dirty with a deep dive into how Airbnb was valued. We'll see how to adjust for the harsh realities of the business world, and we'll wrap up with what the really smart investors are looking for.
Okay, so let's get right to the heart of it. The young company puzzle. What is it about these businesses that makes them so incredibly difficult to value? It really comes down to this unique, kind of dizzying mix of huge promise and just total uncertainty. This chart right here, it tells the whole story perfectly. See that top line? That's revenue. And man, it is rocketing up. That's the dream, right? That's the promise. But then, look at the lines below it. Earnings and cash flow are just plunging into the red. They are burning through cash like crazy to make that growth happen. And that huge, massive gap between the promise and the reality, that's the core of the whole challenge. And it's not just the shape of those curves on the graph. These companies create what the source material calls a perfect storm for valuation. I mean, think about it. First off, you have basically no history to look at. Then you have these massive operating losses. And on top of that, the failure rate is just staggering. The data shows only about 45% of new businesses even make it past 5 years. So when you start layering on other tricky stuff, like stock you can't easily sell and really complex ownership structures, you can see why the old school valuation playbooks just don't work here. So how do we even begin to cut through all this fog? If the traditional methods are so tough, where do we start? Well, broadly speaking, there are 2 fundamental paths you can take to try and figure out what a company is worth. On one side, you've got what's called intrinsic valuation. This is all about trying to figure out a company's fundamental ability to generate cold, hard cash over its entire life. It's an attempt to find out what the business is truly worth, deep down. Then on the other side, you have relative valuation, which is really more about pricing. It's kind of like looking at house prices in a neighborhood. You're not asking what the house is fundamentally worth, you're asking what are people willing to pay for similar houses right now. Now, this way is also pretty tricky for young companies because it's hard to find good comparisons. So for our deep dive today, we are going to focus on that first one, the intrinsic method. All right, enough with the theory. To make this stuff real, we need a real-world example. And we've got a great one. We're going to walk through a super detailed case study from our source material, valuing Airbnb right before its gigantic IPO back in late 2020. This is going to show us exactly how analysts try to build a story about a company's future one number at a time. Every single valuation story starts right here. The top line, revenue growth. For a young company to ever justify a huge valuation, its little revenues today have to have a believable path to becoming enormous revenues tomorrow. The whole thing really hinges on one question. Just how big can this thing get? So, to build this story, analysts didn't just pull numbers out of thin air. First, they had to define Airbnb's total potential market. And we're not just talking about vacation rentals. We're talking about the entire global hospitality business. Then, they projected what slice of that massive pie Airbnb could capture over time. And what you get is this forecast of incredible 40% growth in the first year, which then slows down, but still takes revenues from around $3.6 billion to over $21 billion in just a decade. That is the promise. But look, explosive growth is only half the story, right? A company can't just lose money forever. So that brings us to our second value driver, target margins. You can lose money today, sure, but you absolutely have to have a believable story for how you're going to make money in the future. This number, 25%, is the anchor for that entire story of profitability. Analysts looked at Airbnb, which was posting huge losses at the time, and they asked, okay, once this company grows up and matures, what will its profit margin look like? And to answer that, they looked at the established players, the grown-ups in the room, like Booking.com, and they landed on this assumed target margin of 25%. That gives them a credible pathway to profitability. Okay, so we've got a story for massive growth, and we've got a plan for future profits. But that growth isn't free. You know the saying, you got to spend money to make money? Well, that's exactly what this is. The company has to invest capital to get bigger, and that brings us to value driver number 3, reinvestment efficiency. Basically, how much does the company have to spend to buy all that growth? Okay, I want you to focus on that last column, FCFF. That's free cash flow to the firm. And whoa, it is deep in the red for the first 6 years. I mean, look at year 1. They're burning through over $1 billion. That's the cost of reinvesting for all that growth. But then, look at year 7. As the growth starts to slow down and those target margins we talked about start to kick in, the cash flow finally flips positive. That crossover point is a monumental milestone in this company's story. So now we have this really detailed forecast of all the cash the company is going to either make or burn over the next 10 years. But here's the thing. A dollar that someone promises you 10 years from now isn't worth the same as a dollar in your pocket today, especially when that future dollar is far, far from a sure thing. And that's where our fourth value driver, operating risk, comes into play. And what's really crucial to understand is that risk isn't just a static number. In the early, super uncertain years, you have to discount those future cash flows at a much higher rate. This rate is called the cost of capital, and it's basically the return investors demand for taking on all that risk. For Airbnb, it started high, at 8.5%. But as the company matures and its business becomes more stable and predictable, that risk falls. And so the discount rate drops too, eventually settling at a much lower 7.12%. Okay, we have built our detailed 10-year story. We've got revenues, we've got margins, reinvestment, and risk. We have all the pieces of the puzzle. Now it's time to assemble them, pull it all together, and adjust our grand forecast with a little dose of reality to get to a final number. Now, I know this formula looks a little intimidating, but the concept behind it is absolutely essential. We can't forecast a company year by year forever, right? So after 10 years, we use this terminal value formula as a kind of shortcut. It captures the value of all the cash flows from that point into the future, forever, assuming it's now a stable, grown-up business. And for a young company, this single number can be a staggering amount, sometimes 80 or even 90% of its total value. And that's a huge insight. When you value a young company, you're not really buying its current business. You are buying a bet on its distant, uncertain, but potentially massive future. And here's that formula in action. We plug in the numbers for Airbnb's grown-up phase, its mature earnings, a stable low growth rate, and that lower cost of capital. And the result? A terminal value of almost $64 billion. This one number represents the company's entire projected value from year 11 onward. But wait, we can't stop there. We've just calculated the value of the company, assuming it survives and thrives. But we all know that a lot of startups, well, they just don't make it. And that brings us to our fifth and final value driver, and it's a huge reality check: survival. We have to make a critical adjustment for the very real probability of complete and total failure. So here is the final assembly. You start with the value of the operating assets, now adjusted for a 10% chance of failure, in Airbnb's case. Next, you add in all the cash they have. Then you subtract any debt and the value of all those stock options they've given to employees. Finally, you divide that grand total by the number of shares out there. And after all of that, the intrinsic value lands at $47.17 per share. Whew, okay? We have been deep in the weeds of the calculation. We've seen all the mechanics, but what does this all actually mean for you? Let's zoom out now and boil this whole complex process down to 5 key principles that smart investors are looking for when they size up a young growth company. So what does this all boil down to for an investor? It means you're looking for companies with these specific qualities. First, a gigantic potential market, because that's what allows for that explosive revenue growth we saw with Airbnb. Second, you want to see strong expense controls, because that's what makes a path to high profit margins actually believable. Third, good access to capital. That is absolutely essential to survive those years of burning cash. Fourth, a deep management team that goes beyond just the key founders, which lowers the overall risk. And finally, you want some kind of exclusivity, a powerful brand, a patent, a unique technology, something that's really tough for competitors to copy. So there you have it, the framework for putting a value on pure promise. It's not about finding a single magic number. It's about building a coherent, defensible story about the future that's grounded in these 5 key drivers of value. It's a discipline that forces you to think really critically about what makes a business win or lose. So the final question is, now that you know the framework, which company's future would you be willing to bet on?
So how in the world do you put a price tag on a company like Google? It's a real head-scratcher, right? I mean, its value isn't just in the buildings it owns or the cash it has today. It's all tied up in this massive, incredible potential of what it's going to build tomorrow. In this explainer, we're going to roll up our sleeves and crack the code on how financial experts tackle this exact puzzle, valuing a future that hasn't even happened yet.
So, here's our game plan. First, we're going to define what makes this such a tricky puzzle to begin with. Then, we'll uncover a huge blind spot in the way traditional accounting works. After that, it's all about the solution. We'll clean up the financial books, learn how to forecast the future, and then put it all together for the final calculation. And we'll wrap it all up with a practical playbook you can actually use.
All right, let's start with the big problem itself. Just think about Google for a second. In 2001, it was this small, scrappy startup. Fast forward to 2022, and its operating profits hit almost $75 billion. That kind of explosive growth is exactly what makes valuing it so darn complex. You're not just measuring what the company is today, you're placing a bet on what it's going to become.
And this, right here, is the million-dollar question, isn't it? It's not enough for a company to just get bigger faster. The real value comes from the quality of that growth. Is it actually generating solid returns on the money it's pouring into expansion? That's what separates a company that's just a flash in the pan from a true long-term powerhouse. This definition really gets to the heart of it. You see, with a mature, old-school company, you're valuing its existing factories and equipment. But with a growth company, you're valuing assets that don't even exist yet. You're valuing promises. And as you can imagine, trying to put a price on a promise requires a whole different set of tools.
Now, let's get into the biggest roadblock in this whole process. There's this massive disconnect between how old-school accounting rules work and how modern, tech-driven companies actually build value. In a lot of ways, the accounting rulebook is still stuck in the industrial age.
You know, these growth companies, they just have a different DNA. Their financials are all over the place, not nice and stable. The stock market values them at way, way more than their book value, because investors are pricing in all that future potential, the very thing that the accounting books totally ignore. They usually have less debt and shorter track records, all of which makes a simple by-the-numbers analysis pretty much useless.
And this slide just illustrates the problem perfectly. Accounting was built for an economy of smokestacks and factories. When a car company builds a new plant, that's a capital expense. It's treated as a valuable asset on the books. But when a company like Google spends billions on research and development, which is the absolute engine of its future growth, it's treated like a daily expense, no different than paying the electricity bill. It just vanishes.
This quote from the source material just hits the nail on the head. A core principle of accounting is that if you spend money today to create a benefit that lasts for years, that's an investment. It's an asset. But for some reason, when it comes to these intangible assets like R&D, that whole principle gets thrown out the window. And the result? The financial statements systematically understate the true value and profitability of the world's most innovative companies.
So if the official numbers are misleading, what do we do? Well, we can't just take them at face value. To get to the real truth, we have to roll up our sleeves and become accountants for a minute. We have to clean up the books ourselves.
And here's how we do it. It's a pretty logical three-step process. First, we have to estimate the amortizable life of the research. Basically, how long does it take for a brilliant idea in the lab to actually start making money? For a company like Google, the source suggests about 3 years. Then, you just go back and collect the R&D spending for those last 3 years. And with that, you can calculate the value of a brand new research asset.
And just like that, an abstract idea becomes a concrete number. Take a look at this table. By treating the last 3 years of R&D spending as a long-term investment, we've created something the official accounting completely missed, a research asset worth over $79 billion. That's our first key number. The second is the amortization. You can think of that as the yearly wear and tear on that new asset, which comes out to almost $33 billion.
Now, we take those two numbers and use them to fix the income statement. We start with the official operating income. We add back the entire R&D expense that was incorrectly treated as a daily cost, and then we subtract our new, more accurate amortization figure. And the result for Google is just incredible. Their true operating income is almost $10 billion higher than what they reported.
Okay, now the ripple effect here is fascinating. On the one hand, Google's operating margin jumps from 26% to nearly 30%. This proves the business is even more profitable than it looks on paper. But notice this, its return on capital actually goes down. Now, why would that be? Well, think about it. It's because we're now holding them accountable for that massive $79 billion research asset we just put on their books. They have more capital invested in the business, so their return on that bigger pile of capital is naturally a bit lower. This gives us a much more honest picture of their real performance.
So with the books all cleaned up, we finally have an accurate snapshot of the company today. Now, we can turn our attention to the exciting part, forecasting the future. And a good forecast isn't just about pulling numbers out of thin air. It's about telling a convincing story based on these 4 key drivers of value.
A credible forecast is really built by answering 4 crucial questions. First, is the growth scalable, or is the company going to hit a wall eventually? Second, can it protect its profit margins, or will a wave of new competitors eat them away? Third, and this one is so important, is it quality growth? Are they actually earning more on their new investments than what that money is costing them? And finally, how will the company's riskiness change as it gets bigger and older?
When you answer those questions, you end up with something that looks like this. And this table, right here, is the absolute heart of the entire valuation. You can see the story it tells over 10 years. Revenue growth gradually slows down, which you'd expect for a giant company. But its earnings, or EBIT, keep climbing.
And that bottom row, FCFF, or free cash flow to the firm, that's the golden number. That's the actual cold, hard cash we expect the business to spit out for all its investors year after year.
All right, we've got our forecast. We have these piles of future cash all laid out. Now comes the final and most crucial step, putting all these puzzle pieces together to figure out what that's all worth right here, right now.
To turn future money into today's money, we need a special tool called a discount rate. You can think of it like an interest rate, but in reverse. It's all based on how risky the company is. For Alphabet, the calculated rate, or cost of capital, is 11.27%. All this means is that because the future is uncertain, a dollar we expect to get next year is only worth about 89 cents today. The riskier the company, the higher the discount, and the less all that future cash is worth.
Now, our forecast only goes out 10 years, but we expect Google to be around for a lot longer than that. So we have to capture the value of all its cash flows from year 11 to infinity. Sounds impossible, I know, but we can do it with a formula for what's called terminal value. And look at the result. It is a staggering number, almost $2 trillion. This one number represents the value of Google's entire long-term future, and it's almost always the single biggest piece of the whole valuation puzzle.
And now for the grand finale. We take every single one of those cash flows from our 10-year forecast, we add that massive $2 trillion terminal value, and we discount everything back to today using our 11.27% rate. After a couple of final adjustments, adding the cash they have on hand, subtracting their debt, and dividing by all the shares, we arrive at our answer. Our calculated intrinsic value for a single share of Google is $112.79.
This is the moment of truth. On one side, we have our number, the value we so carefully calculated, $112.79. And on the other side, we have what people were actually paying for a share back in August of 2023, $131. The verdict from our analysis is crystal clear. At that specific point in time, the stock looked overvalued.
So after all of that number crunching and theory, what's the big takeaway? How can you, as an investor, actually use this framework to make smarter decisions? Let's distill it all down into a simple, actionable playbook.
It all comes down to three core ideas. First, you want to hunt for scalable growth, businesses that have a huge runway ahead of them. Second, demand sustainable profit margins. That's the sign of a real competitive advantage, a moat around the business. And finally, and this might be the most important rule of all, be disciplined about the price you pay. Because what our entire analysis just proved is that even a phenomenal company like Google can be a lousy investment if you buy it at the wrong price.
Which leaves us with this one final thought. Sooner or later, even the best growth companies will stumble and their stock prices will take a hit. When that happens, is it a reason to panic and sell everything? Or is it the market handing you a golden opportunity to buy a fantastic business at a fair price? Doing the hard work of understanding its true, intrinsic value, well, that's what gives you the confidence to answer that question.
All right, let's jump right in. You know, when you think about these giant established companies, like a Coca-Cola or a GE, they kind of feel like open books, right? They've been around forever, we all know their products, so valuing them should be easy, or so you'd think. But the thing is, that stability, it can be a real illusion, and it often hides some pretty fascinating opportunities.
And that really gets us to the big question here, doesn't it? Are these corporate giants just, I don't know, a safe, maybe even boring bet for your portfolio? Or is there something more? A hidden potential, a value that most of the market just isn't seeing? Well, that's exactly what we're going to dig into.
Okay, so first things first, we've got to talk about this illusion. It's a really common trap. We see a stable, old company, and our brain just automatically goes, oh, this is simple, easy to value. But that assumption, it is a huge mistake.
Now, to be fair, a mature company does have a pretty typical profile. I mean, look at this list. Their growth starts to slow down, basically matching the rest of the economy. Their profit margins, they're pretty much set in stone. They've usually got these incredible competitive advantages, like a brand name everyone knows. And because they're so stable, they can take on more debt, they start to hoard cash, and a lot of times, the only way they can really grow is by buying up other companies. This is the classic mature company playbook.
But, and this is a big but, here's the trap. If you only look at that history, their past earnings, the decisions they've made before, and you just assume that's the only way things can be done, well, you might be missing the entire point. You're not valuing the company for its full potential. You're just valuing it based on its current management. So the question is,
how do we actually find that hidden potential? It turns out there are really three main levers. Three big things an investor, or maybe a new CEO, can pull to completely change a company's value. Let's break them down. Yup, these are the big three. First, you can just run the core business way more efficiently. That's what we call operating restructuring. Second, you can totally change up the financing mix, finding that perfect balance between debt and equity. And third, you can do a much better job with all the stuff that isn't part of the main business, like that giant pile of cash just sitting there.
Okay, to make this super concrete, let's zoom in on that second lever, financial restructuring. And we're going to use a perfect case study, the consumer goods giant Unilever, to see just how much value you can unlock by finding that financial sweet spot.
All right, before we dive into the nitty-gritty numbers, we've got to get our heads around this one crucial concept, the cost of capital. Just think of it like this. It's the average interest rate a company pays for all the money it uses, whether that's from loans or from investors. It's a blend. And the goal is always, always to get this number as low as humanly possible. A lower cost of capital means a more valuable company. Simple as that.
Okay, now this table looks a little intimidating, but it actually tells a fascinating story. Let's find the row for where Unilever actually was at the time. They had a debt ratio of around 17%. Now follow that row over to the last column, the WACC, or cost of capital. It's 9.91%. But here's where it gets cool. Watch what happens when we start adding a little more debt. At first, since debt is generally cheaper than equity, the overall cost of capital actually goes down, and it hits this perfect sweet spot, a minimum, right there at a 30% debt ratio. But if you go past that, whoa, the company gets way too risky and that cost of capital just skyrockets.
So after all that, what's the one number you really need to take away from that table? It's this, 30%. The analysis showed that Unilever's perfect financial sweet spot was having 30% of its financing come from debt, not the 17% it was actually using. And that difference, believe me, has a massive impact on the company's true value.
And this all leads us to what is honestly the most powerful and probably the most overlooked element when you're valuing a company: the people running the show. The decisions that management makes, or just as importantly, the decisions they don't make. That's the ultimate X factor.
Now, to really wrap your head around this, you have to think about two different kinds of value. On one side, you have the status quo value. That's what the company is worth right now, today, being run exactly as it is. But then there's the optimal value, and that's what the company could be worth if every single lever was pulled perfectly, if it was run to its absolute maximum potential.
And this formula really just nails the whole idea. The difference between that optimal value and the status quo value, that right there is the value of changing management. It is the hidden potential that's just locked up inside the company, waiting for some kind of catalyst to set it free.
So bringing it back to Unilever, what did this actually mean in dollars and cents? Or, well, euros. The difference was absolutely huge. The status quo value was calculated at about 42 euros per share, but the optimal value, if the company were run better, over 49 euros. That gap, that hidden potential we keep talking about, was worth a stunning 6 euros and 61 cents for every single share of stock.
But here's the thing, the market isn't dumb. It kind of anticipates this stuff. So the actual stock price you see on any given day isn't just the status quo value. It's really a weighted average. It's the status quo value plus that extra potential value multiplied by the chance, the probability, that management is actually going to change and unlock it.
Okay, let's put all the pieces together for Unilever. If we make an educated guess and say there's about a 60% chance that management will eventually make these better, more optimal choices, we can calculate a final expected value. We're just blending the low-end status quo value with that higher-end optimal value, and we land at 46 euros and 41 cents per share. That is the number a really smart investor is going to compare to the current stock price.
All right, so now that we know all this, how do you actually use it? I mean, what does this mean for an investor? Well, it really creates two totally different strategies, two different ways to play the game and profit from these big, mature companies.
On one side, you've got the passive value approach. Think of it as the Buffett way. You go out and find really well-run, solid companies that are just temporarily unloved or maybe a little boring for the market right now. You buy them, confident that their quality will eventually shine through again. Then, on the other side, you've got the activist approach, the Raider way. Here, you are specifically hunting for badly run companies where that gap between the status quo and the optimal value is massive, and, crucially, where you think some kind of change is about to happen.
So if that second path, the activist path, sounds interesting to you, what are the telltale signs? What are you looking for? Well, it's a company whose operating margins are way lower than its competitors. It's a company with a low return on its capital. You're looking for that financial slack we talked about, like a super low debt ratio. And this is critical. You have to make sure there's nothing stopping a takeover. And if you can, you want to find a catalyst for change. Maybe an aging CEO, or a new aggressive investor who just joined the board. That's your signal.
And all of this brings us to one final big question. Now that you have this framework, now that you know how to look for this hidden value, which of the corporate giants that you see every single day do you think is hiding the most value right now? Which one is just sitting there, waiting for the right person or the right event to come along and unlock its true potential?
Welcome to The Explainer. Today, we are tackling a really tough one, something that trips up even seasoned investors. How do you figure out what a company is actually worth when it looks like it's circling the drain?
All right, here's how we're going to break it down. First, we'll get a handle on what doomsday investing even is. Then, we'll dig into why these companies are such a puzzle to value in the first place. After that, we'll walk through two completely different ways to value them using a real-world case study. And finally, we'll ask the big question, is this kind of investing right for you?
You know the names: General Motors, Sears. Once they were the titans of their industries, absolute giants. But eventually, they hit the skids. And while most investors are running for the hills when this happens, a certain type of investor leans in, looking for a hidden opportunity.
But let's be crystal clear about this. The source material puts it perfectly. This is absolutely not for the faint of heart. We're talking about a high-wire act that requires more than just guts. You need a seriously solid game plan to even think about playing.
So what is it about these companies that makes them such a head-scratcher? Well, it's pretty simple, actually. All the usual tools you'd use for investing, you can pretty much just toss them right out the window. You know the signs. First, the revenues start to dry up or fall off a cliff. Then the profit margins get squeezed till there's nothing left. You'll see them start selling off pieces of the business just to raise cash, and all the while, that mountain of debt just gets bigger and bigger, threatening to crush the whole operation.
And here's the real kicker. How do you value a company using standard metrics like a price-to-earnings ratio when the earnings, are negative? You can't. The math just doesn't work. The old playbook is useless, which means we need a totally new way to look at the problem.
So to really get our hands dirty with this, we're going to walk through a real-world example focusing on an adapted valuation model. And our guinea pig is going to be the retail giant Bed Bath & Beyond, right during its big crisis in 2022. The very first thing you have to do is calculate what's called a going concern value. You're basically asking a really optimistic question. Let's just pretend for a second that they pull it off, that they survive this whole mess and get back on their feet. If that happens, what could this company be worth?
Okay, now look at these numbers. What's fascinating here is that we're not pretending a miracle happens overnight. The model assumes revenues are going to keep falling for 5 years. But then it imagines a new business model starts to work, margins climb back to the industry average, and the company finally starts generating positive cash flow again.
So after you crunch all those numbers, you factor in the debt, you add in the cash on hand, you land on our best case scenario value, $4.89 per share. But remember, and this is a huge if, that's the value if the turnaround actually works.
Right. That's the million-dollar question, isn't it? That whole valuation is built on hope. Now we need to bring in a heavy dose of reality. We have to figure out the actual odds that this company is just not going to make it.
And we can actually put a number on that risk using historical data from credit agencies like Moody's. And look at this chart. The relationship is crystal clear. The worse a company's bond rating, the higher the historical chance it's going to go belly up within a decade. It's a steep, steep climb.
And for Bed Bath & Beyond, back in 2022, they were sitting at a B rating. And based on a century of data, that translates to a nearly 32% chance of failure. Think about that for a second. That's a 1 in 3 shot of the whole thing going to zero.
And going to zero isn't just a figure of speech. In a bankruptcy, everyone gets in line to get paid, right? Lenders, suppliers, and the stockholders, they're dead last. In this scenario, after they sell everything off in a fire sale, there's not even enough cash to pay back the big lenders. So for the stockholders, you guessed it,
a big, fat zero. Okay, so this is where we put it all together. You've got a roughly 68% chance of the stock being worth $4.89 and a 32% chance of it being worth nothing. You blend those two possibilities together, and what do you get? A much more sober, probability-adjusted value of just $3.33 per share.
But hold on, that's just one way to slice it. There's a totally different approach we can take. Instead of looking inside the company at its own potential cash flows, what if we just looked around? See what the market is willing to pay for similar but healthier companies. This isn't just a different formula. It's a whole different ballgame.
Yeah, this really gets to the heart of it. Are you trying to calculate what a company should be worth based on its own potential? That's intrinsic value. Or are you just trying to figure out what the market is pricing it at right now by looking at its competitors? That's relative pricing. Two totally different mindsets.
And when you run the numbers using the second method, whoa, the result is even harsher. The model spits out a value that's less than zero. Now, what on earth does that mean? It suggests that the market is so pessimistic, that the risk of failure is so massive, that even if the company does recover in 10 years, the stock is still so overpriced today that it's essentially worthless.
So let's just recap. One method says the stock is worth a few bucks. The other says it's worth less than nothing. So why would anyone in their right mind touch a stock like this? Well, it turns out there are a couple of very specific, very risky strategies in play.
You've basically got two kinds of doomsday investors. The first is playing the long, slow game. They're not betting on a miracle. They're just collecting cash from a managed decline as the company sells itself off piece by piece. The second type, they're the true gamblers. They're making that high-risk, all-or-nothing bet on a full-blown resurrection, hoping for a spectacular payday.
And if you're gonna be one of those gamblers, you can't just cross your fingers and hope. The source material is clear. You need to look for a few key things. Is there still a good, valuable business hiding underneath all the problems? Is there a credible plan to deal with that mountain of debt? And critically, can they get their hands on fresh cash to survive the storm? Look, at the end of the day, the potential to make a fortune here is real, but the potential to lose every single penny is just as real, if not more so. The framework we've talked about can help you analyze the situation, but it can't make the decision for you. So the real question isn't just about the numbers on a spreadsheet, it's about you. Do you really have the stomach for it?
All right, today we are tackling what might be one of the toughest nuts to crack in all of finance. How do you actually figure out what a bank is worth? You see, for most companies, the valuation rulebook is pretty straightforward. But when it comes to financial firms, well, that's a whole different ballgame. They play by a completely different set of rules. So our mission today is to crack that code together.
For the longest time, this was just common knowledge. You'd buy some shares in a big household name bank, collect those nice quarterly dividend checks, and you'd sleep like a baby. I mean, they were supposed to be the bedrock of a safe portfolio, heavily regulated, incredibly stable, and just plain solid. They were, for all intents and purposes, the definition of a safe bet.
And then 2008 happened, and that whole illusion of absolute safety just completely shattered. The financial crisis threw back the curtain and showed us that even these massive, too-big-to-fail institutions were taking on some absolutely wild risks. And that brings us right to the heart of our challenge today. How on earth do you value a business that looks so simple from the outside, but is hiding so much complexity right under the surface?
So here's our game plan for today. First, we're going to peek inside what I call the banking black box to really get why these companies are so different. Then, we'll see how focusing on equity is the real key to unlocking their value. After that, we'll get practical with a tale of two real-world banks, look at a couple of other cool ways to value them, and then wrap it all up with a super handy checklist you can use yourself.
Okay, let's get into it. Before we can learn how to value a bank, we first have to understand why all our usual valuation tools, the ones that work perfectly for, say, a car company or a tech firm, just completely fall apart here. It's time to open up the black box.
This slide right here is the absolute key to the whole puzzle. Just think about it for a second. For a regular company, debt is simple. It's money they borrow to buy stuff, like a new factory. It's a liability. End of story. But for a bank, debt is their entire business. It's the raw material they work with. They take in deposits, which is debt, and then they lend it out. It's an asset and a liability at the same time. And when they reinvest, they're not buying new machines. They're investing in things you can't even touch, like their brand or their talent. All of this makes trying to figure out their cash flow just incredibly difficult.
So, if we can't get a clear read on a bank's cash flow, and we can't even properly define its debt, where do we go from here? What's the move? Well, we have to change our perspective entirely. Instead of getting lost trying to value the whole complicated firm, we're going to zero in on the one thing that really matters to us as investors, the equity. Let's check out how this works. And this right here is our star player, the dividend discount model. The idea is actually really simple, but it's also incredibly powerful. Since a bank's internal cash is a total mystery, we're just going to focus on the one piece of cash we can actually see and hold in our hands, the dividends they pay out to shareholders. At its core, the model says the value of a stock today is just all of its future dividends, added up and adjusted for the fact that a dollar tomorrow is worth less than a dollar today.
Okay, let's make this real and get our hands dirty with an actual example. Citigroup. The first piece of our puzzle is something called the cost of equity. Just think of it as the minimum return an investor needs to feel like buying Citigroup stock is worth the risk. For Citi, back in May of 2023, that number was 11.67%. That's the number we'll use to discount all those future dividends.
Now, what about growth? How do we figure that out? Well, a bank's future growth isn't just a random guess. It's actually driven by two really important things, as you can see in this simple little formula. First, how profitable is it? We measure that with something called return on equity, or ROE. And second, how much of that profit does it actually plow back into the business to grow even more? That's the part it doesn't pay out in dividends.
So let's plug in the numbers for Citigroup. Their return on equity was 8.78%, and they paid out just over 29% of their profits as dividends. That means they kept or retained the other 71% to reinvest. So you just multiply that ROE by the percentage they kept, and boom, you get an expected growth rate of 6.22%. See? It's not magic, it's just math that links how profitable a company is today to how fast it can grow tomorrow.
Now that we have that 6.22% growth rate, we can start to map out what the next 5 years might look for Citigroup. As you can see in this table, we're projecting that both their net income and the dividends they pay out will climb steadily. This 5-year window is what we call the high growth phase. It's the period where we think the bank can keep up that pace.
But of course, Citigroup isn't just going to disappear after 5 years, right? So we have to figure out the value of all the dividends it's going to pay from year 6 forever. For that, we calculate something called a terminal value. Think of it as a single number that represents the company's entire future once it settles down into a more normal, stable growth rate for the long haul. It's how we capture the value of infinity.
So you take the value of those first 5 years of dividends, you add the value of everything after that, our terminal value, and we get our final number, an intrinsic value for Citigroup of $55.68 a share. And here's where it gets really interesting. At that time, the stock was actually trading for only $46.32. So our model suggests that even with some pretty conservative guesses, the stock looked undervalued.
Okay, so coming up with a value of $55 is pretty cool, but valuation never happens in a vacuum. There's what a company is worth, and then there's what people are actually willing to pay for it. And that brings us to our next idea, relative pricing, where we stop looking at a company on its own and start comparing it to its peers.
And this table sets up a classic investor face-off, Citigroup versus its big rival, JP Morgan. And wow, just look at these numbers. JP Morgan is way more profitable, with a much higher return on equity. But the market knows this, right? Which is why it trades at a price-to-book ratio 3 times higher than Citi's. You are paying a big premium for that quality. Citigroup, on the other hand, is trading for half of its book value, but its performance is just not as strong.
And this leads us to the million-dollar question every single investor has to ask themselves. I mean, it's obvious JP Morgan is the better bank. The numbers don't lie. But the real question, the harder question, is which one is the better investment at today's prices? Is Citigroup's huge discount big enough to make up for its weaker performance, or has the market gotten it exactly right?
Now, the dividend model is a fantastic tool. It's our workhorse. But it's not the only tool in the shed. To get a really full picture, it's always a good idea to look at a company through a few different lenses, a few different models, to get a deeper sense of what's going on. So let's look at a couple of other powerful ways to do this.
First up, we have the free cash flow to equity model, or FCFE. It's kind of like the dividend model's cousin, but instead of looking at the dividends a company does pay, it looks at the dividends a company could pay. Its big insight is changing what reinvestment means. For a bank, reinvestment is the regulatory capital, the cash cushion it has to keep on hand to back up its growth. So FCFE shows us a bank's maximum possible payout power, which tells you a lot about its health.
The other alternative is the excess return model, and this one I think is just brilliant because it gets right to the heart of how companies create or destroy value. It splits a company's value into two simple parts. Its book value, which is all the money that's already been invested, plus the value of all the excess profits it will make in the future. So what exactly are excess profits?
Well, this slide shows you the engine of value creation. A company only creates real value when its return on equity is higher than its cost of equity. In other words, when it earns more than investors demand. That positive gap, that spread, that's the secret sauce. Now think back to Citigroup. Its ROE was about 8.8%, but its cost of equity was over 11.6%. That means for every dollar it reinvests to grow, it's actually destroying a little bit of shareholder value.
Okay, so we've covered the theory, we've done the math, we've looked at different models. Now let's boil all of this down into a simple, actionable checklist you can use anytime you're looking at a financial company. This will help you see past the numbers and really judge the quality of the business itself.
Here are the 4 big questions you've got to ask. 1. How well capitalized is it? Does it have a nice fat cushion of capital above what the regulators require? 2. Where is its risk coming from? Are its profits from boring, predictable loans or from risky trading? 3. How transparent is it? Do you feel like they're being straight with you in their reports, or are they hiding the important stuff in the footnotes? And finally, 4. What's its competitive advantage? Does it have a special niche or a strong brand that protects it from everyone else?
And we'll leave you with this one last thought, because valuing financial firms really forces you to face one of the biggest questions in all of investing. Are you buying a great company that everybody already knows is great, or are you buying a good stock that maybe the market has overlooked? As we saw with JP Morgan and Citigroup, those two things are definitely not always the same.
You ever look at a company in, say, the auto or oil industry and just wonder why its value swings so wildly? I mean, one minute it's up, the next it's way down, even when the company itself hasn't really changed. It's like being on a financial roller coaster, and the ride is being driven by forces way outside of any one CEO's control. Well, today we are strapping in and grabbing a front row seat on that ride. We're going to figure out how to value these volatile, but, and this is key, potentially very rewarding companies.
So, here's the game plan. First, we're going to define the problem itself, that wild valuation roller coaster. Then, we'll open up the toolkit for smoothing out those bumps. After that, we'll put theory into practice with a deep dive on Toyota. From there, we'll tackle the unique puzzle of commodity companies, check out a couple of advanced tools, and then we'll bring it all home with an investing playbook you can actually use.
All right, first things first. Before we can figure out how to value these companies, we need to get a real handle on the beast we're trying to tame. Let's dig into the sheer, externally driven volatility that defines them. Okay, picture this. It's 2007. The global economy is absolutely humming. People are feeling good, spending money. What do you think a world-class company like Toyota is worth? Now just snap your fingers. It's 2 years later, 2009. We're in the pit of a massive global recession. What's Toyota worth now? I mean, think about it. Its factories, its brand, its engineers, they're all still there, but its value has been completely rocked by the economic cycle. This is the central problem we're here to solve.
So we're really dealing with two different kinds of companies here, but they share the exact same headache. On one side, you've got your cyclical companies. Toyota is a perfect example. Their success is literally tied to how the economy is doing. When times are good, people buy cars. When a recession hits, well, that new car purchase is one of the first things to get put on hold. Then on the other side, you have commodity companies, your oil drillers, your gold miners. They're what we call price takers. They're basically at the mercy of the global market price for whatever they're selling. The bottom line? For both of them, their earnings are on a wild ride they can't steer.
So if a company's current earnings are all over the place and totally unreliable, how in the world are we supposed to figure out what it's truly worth? Well, the answer lies in a really powerful technique for looking right past all that short-term noise. It's called normalization. The whole point of normalization is to find a company's real underlying earning power stripped of all the distortions from a boom or a bust. And we've got 3 main tools in our toolkit to do this. First up, the simplest approach. Just average the company's earnings over a full economic cycle, say the last 5 to 10 years.
Second, a slightly smarter method. You average their profit margins over time, and then you apply that stable, average margin to their current revenues. This is great because it accounts for growth. And third, if a company's new or its history is just a mess, you can just borrow the average margin for its entire industry.
Okay, theory is one thing, but let's make this concrete. We're going to take that toolkit we just talked about and apply it to the exact problem we started with, trying to value Toyota right in the thick of the 2009 recession.
So here's where the rubber meets the road. It's early 2009. The global financial crisis is in full swing. And Toyota, one of the best-run, most efficient car companies on the planet, actually reported a loss. A loss. Now, if you just take negative earnings and plug them into a standard valuation model, you get a completely useless, nonsensical answer. This is the exact moment where normalization isn't just helpful, it's absolutely essential.
Okay, let's crunch the numbers. We're going to use that second method from our toolkit, the one with the average margins. So we look at Toyota's average operating margin over a full cycle, from 1998 all the way to 2009, and it turns out to be 7.33%. Now we take that stable, long-term margin and multiply it by the company's most recent revenues. And boom, we get a normalized operating income of 1,660.7 billion yen. Just like that, we've replaced a temporary, scary-looking loss with a much more realistic picture of the company's long-term ability to make money.
Now, what do we do with this brand new normalized income? We plug it into a standard valuation formula. And hey, don't get hung up on memorizing this thing. The big idea here is that this formula takes our stable income number, accounts for things like taxes, growth, and risk, and then spits out a single number that represents the total value of Toyota's core business.
And here you can see that formula in action. We pop in our normalized income of 1,660.7 billion yen, make some reasonable assumptions about the future, and the math tells us that the value of Toyota's core car-making business, its operating assets, is about 19,640 billion yen.
But hold on, we're not quite done yet. See, a company is more than just its factories and assembly lines. To get to the number that shareholders really care about, we have to make a few final tweaks. We take that operating asset value, we add in all of Toyota's cash and its investments, and then we subtract out its debt. You do all that, and you get the total value of the equity, the final piece of the puzzle.
And here it is, the big payoff. After we divide that total equity value by all the shares out there, we get a value of 4,735 yen per share. Now, you gotta remember, this was in early 2009. The market was in full-on panic mode. The actual stock price for Toyota at that time? Just 3,060 yen a share. This is a perfect illustration of how normalization can help you see incredible value when everyone else is just seeing a temporary crisis.
All right, so we've got a handle on cyclicals. Now let's switch gears and talk about their cousins, the commodity companies. With these guys, the big driver isn't the whole economy, it's the price of one specific thing. In this case, we're talking about oil, and our example is Royal Dutch Shell.
Okay, check out this chart because it tells you almost everything you need to know. That blue line is the price of oil. The red and green bars, that's Shell's revenues and income. I mean, look at them. They move in almost perfect lockstep. The connection is so strong it has what's called an R-squared of 92%. All that means in simple terms is that the price of oil explains a whopping 92% of the changes in Shell's business. They are tied at the hip.
So it stands to reason that if you want to value Shell, you have to start by making a call on the future price of oil. This table shows you exactly what that looks like. It starts with today's oil price and then projects out Shell's revenues and income for the next 5 years. You'll notice that the operating income is expected to come down from its peak. That's just normalization at work, assuming oil prices won't stay high forever. And this all generates a stream of expected cash flows for the future.
This chart just makes the point undeniable. It shows you the calculated value of a single share of Shell stock at different long-term oil prices. If you think oil is going to be $40 a barrel forever, the company is worth less than $40 a share. But if you think oil is headed to $150 a barrel, that value explodes to over $120 a share. The implication is just massive. Valuing a commodity company isn't really about valuing the company's management or strategy. It's fundamentally a bet on the future price of that commodity. Period.
Now, normalization is our bread and butter tool for sure, but there are a couple of more advanced concepts that can add some serious depth to our analysis. Let's take a quick look.
You know, a lot of analysts love to use these simple pricing ratios, like the price to earnings or PE ratio, as a shortcut. But this table shows you why that can be so dangerous. Take a look at Shell.
Its PE ratio of 6.93 is below the median, which makes it look kind of cheap. But if you look at the other metrics, it's pretty much right in line with its peers. And then you see Petrobras with that super low PE of 2.7, but that one number completely hides all the extra risk that comes with its operations in Brazil. You gotta look at the whole picture.
Okay, now, this next idea is really fascinating. Think about an oil company's undeveloped reserves, all that oil still sitting in the ground. You can think of it like a financial option. The company has the right, but not the obligation, to drill for that oil. And they're only going to exercise that option if the price of oil is high enough to make a good profit. Now here's the crazy part. The more volatile and unpredictable oil prices are, the more valuable this option becomes, because it increases the chances of a massive price spike. And what that means is a standard valuation might actually be underestimating the true value of companies with huge undeveloped reserves.
Okay, we have covered a ton of ground here, from smoothing out earnings to the puzzle of commodity prices to these cool real options. So, what do we do with all this? How do we actually turn this knowledge into a smart investment strategy?
Well, it really boils down to two main strategies, two different bets you can make. For cyclical companies, your investment is a bet on the economy. If you think a recession is bottoming out and an upswing is just around the corner, that is the perfect time to buy strong cyclical companies that have been beaten down by all the pessimism. For commodity companies, your investment is a bet on the commodity's price. If you are convinced the price of oil or gold or copper is heading higher, you want to invest in companies that have huge, low-cost reserves still in the ground, because they're the ones who will benefit the most.
And this quote just wraps it all up so perfectly. You can't get away from the ups and downs with these companies. It's just baked into their DNA. But the real insight here is that this volatility, it isn't just a risk you need to be afraid of. It is the very thing that creates the biggest opportunities for investors who have done their homework. So I'll just leave you with this final thought. The next time the economy stumbles, the next time a commodity price crashes, and you see the headlines screaming and investors are panicking and selling everything, are you going to see only the risk that they see? Or, now that you're armed with this toolkit of normalization, will you be able to look past all that noise and see the opportunity?
Hey there! If you've ever looked at financial valuation and thought it was some kind of dark art, well, you're in the right place. Today, we're going to pull back the curtain and demystify the whole thing. We're breaking it all down into a simple, really powerful framework that you can actually understand and use, no matter what company you're looking at.
All right, so here's our game plan. We're going to start with the absolute basic building blocks of any valuation. Then we'll look at the two main ways you can approach it. After that, we'll see how a company's age totally changes the game. We'll talk about the payoff, making money. And then we'll wrap it all up with 10 essential rules to keep you on the right track.
Okay, first up, let's get right to the heart of it. We're going to uncover the universal recipe, the fundamental constants that are at the center of every single valuation. And I mean every single one. And this quote, it just nails the core idea. Seriously, it doesn't matter if you're trying to value a hot new tech startup or some legacy company that's been around forever, the fundamental principles, they never change. Value always, always comes down to the same key ingredients. And here they are. It's that simple. Every single valuation you will ever see, I don't care how complicated the spreadsheet is, it all boils down to just these three things: the cash a business can generate, its potential to grow those cash flows over time, and the risk that, well, you might not actually see that money. That's it. Cash, growth, and risk. Remember those three. So now that we have our ingredients, let's talk about how we actually use them. There are basically two different ways to do it. Two different lenses we can look through to figure out what something is worth. And this brings you to a really key choice, a decision every analyst has to make right at the start. Before you even think about numbers, you have to decide what fundamental question you're actually trying to answer about a company's worth. And here are your two paths. On one hand, you can look inward, focusing only on the company itself, its cash flows, its risk. That's what we call intrinsic valuation. On the other hand, you can look outward and see how it stacks up against its competitors. That's relative valuation, where you're really just pricing it based on how the market is pricing other similar companies. Now, this is super important to get. Neither one of these is right or wrong. They just answer totally different questions. For instance, with a company like Alphabet, an intrinsic valuation might say it's overvalued based on its future cash potential. But a relative valuation could look at it and say, hey, compared to other tech giants, it's fairly priced. See? One looks at the company in a vacuum, the other looks at it in the context of the market. Which one you choose depends entirely on the question you need to answer. Okay, so we've got our three ingredients: cash, growth, and risk. Let's dig into how our focus on each of these really shifts depending on the kind of company we're looking at and where it is in its life cycle. And what's so fascinating here is that it shows you that valuation isn't some rigid, one-size-fits-all formula. Not at all. It's an adaptable framework. The core components are always there, but what you choose to emphasize, the most important part of the story, changes dramatically. This table shows that shift perfectly. I mean, think about it. For a young, high-growth company, it's all about two things: revenue growth and just plain survival. But for a mature company, the focus shifts to efficiency, to finding what we call operating and financial slack, which is just a fancy way of saying finding ways to run the business better and manage its finances smarter. And for a company in decline, you're asking totally different questions like, what's its going concern value, and what's the chance it could go bankrupt? Same ingredients, just a completely different focus. Okay, here we go. This is the section everybody wants to know about. We've done all this work, we've built the models, so how does this actually translate into successful investing in, making a profit? This is the payoff, right? So after all that effort, can a good valuation actually lead to good returns? The honest answer is that it depends. Yeah, it's not quite as simple as just being right about the value. In fact, your success as an investor really comes down to this complex interplay, this delicate dance between three very distinct variables. And getting just one or two of them right, well, that's not enough. So first, you've got the quality of your valuation. I mean, that makes sense. Better analysis should lead to better returns. Second, there's market feedback. For you to actually make money, the market has to eventually see what you see and correct its mistake. And third, there's the one we don't like to talk about, but is always, always there: pure, simple luck. So what do you do about that? Well, here's the crucial takeaway. While you can't control luck, you absolutely can manage its impact. On any one investment, luck can totally overwhelm even the best analysis. But you can reduce its power over your whole portfolio by diversifying. Spreading your bets across many different companies you think are undervalued is your best defense against a bad roll of the dice. So to bring all this together into something you can actually use, here's a toolkit. 10 simple but incredibly powerful rules to guide you on your journey. Think of these as your guardrails, keeping you on the road. Let's run through the first 5. Number 1, abandon models, not principles. Your spreadsheet could be wrong, but those core ideas of cash, growth, and risk, they're timeless. 2, heed the market, but don't just blindly follow it. You need to know what the market thinks, but your decision has to be your own. 3, risk affects value. This is huge. Risk isn't just a number, it's a real thing that can destroy returns. 4, growth is not free. A company has to spend money to grow, and sometimes that cost isn't worth it. And 5, all good things come to an end. No company grows to the moon forever. Eventually, reality always kicks in. And here are the final 5. 6, watch out for truncation risk, which is just a fancy way of saying, remember that a lot of companies just fail. They don't make it. 7, look at the past for clues, but don't assume the future is just a copy-paste job. 8, draw on the law of large numbers. What that means is averages across a whole bunch of companies are often more reliable than one specific data point. 9, accept that there's uncertainty. You can't get rid of it, so build it into your thinking with a range of possible outcomes. And number 10, my personal favorite, convert your stories into numbers. It's so easy to fall in love with a company's story, but for it to be a great investment, the numbers have to back up that narrative. Okay, before we finish up, I want to leave you with 2 last thoughts. Now, these aren't technical rules you'll find on a spreadsheet, but honestly, they might be the most important takeaways from this entire explainer. Seriously, remember this. A lot of the time, the so-called experts are looking at the exact same information you are, and their fundamental understanding is no deeper than yours can be. You have access to the same tools. You can do this. Be confident in your own analysis. And finally, maybe the most important rule of all, don't be afraid to get it wrong. Valuation is a journey of learning. It's not some test that you either pass or fail once. So embrace the whole process, learn from everything, the wins and especially the losses, and with a bit of luck, you'll find just as much joy in the analysis as I have. Thanks for sticking with me.